Hey everyone, welcome back. Next section we're talking about is basic oscillators. So these are the RSIs and the stochastics. So let's just jump straight into it. So momentum's really looking back. What we're simply doing here is saying, let me take the price today. Let me compare that with the price. This is a 10-period one on the chart. So I'm going to go back 10 periods and say, what was the price then? Measure the difference, and that's my momentum value. Not really physically correct momentum, from a physics point of view. Momentum would be more about speed, but nevertheless, that's momentum in technical analysis world. So again, a bit of a naming error there. That calculation then gets repeated for every bar. And so what it does is that once we start getting a little bit of weakness, it shows it very, very quickly. And we can see fairly quickly, when there's a change in trend about to happen there. The slope as well tells us about the acceleration. The steeper the momentum line is at the bottom there, then we know that it's accelerating quite fast. The other great thing about it is that it doesn't have the lag of a moving average. So if you take this example here, we've got 60-period momentum, 60-period moving average. Now in this case here, they were both pretty much on par. The market moves so fast that the market crossed the moving average quite quickly. But you come back to this case here, and we've got our signal. There was a bit of a false signal there, but we've got another signal here, and then we come up, that's still a couple of days before the moving average there lagged. Now the other thing it can tell us is you can see here, this whole time, our price is above the moving average. So by simple moving average signals, we'd stay in, we'd stay in, we'd stay in. But look here when momentum peaked. So this peak in momentum, and then the drop off, the lower peak there confirming, almost like, well, it's not really divergence because it's being confirmed in price. But you can see straight away that we've got price going down, we've got the momentum indicator going down. We would be wanting to be out of that market. And so we get this earlier signal than what a moving average would have given us for the same length. Momentum is trend. As I said, we can use it like for following. So these little signals here are simply just taking the crossovers. We already seen it's not really the best. I think better signal would be looking for turns and those sorts of things. But make sure you understand what we're doing there with momentum as a trend indicator. You can again use the software and look at all those signals. A band would be useful in this one, just again to reduce some of that whipsaw. All right, so MACD. Now, we've talked about this in the moving average section. We've got the MACD as being the difference of two exponential moving averages, and then taking that difference and creating another moving average of that. And so the 1226 are our first two. The 9-period is the third moving average on the top of that. And then we take the distance between them. So if you look again at, where's my cursor? So if you take the gap between the blue shaded area and this black line, well, that's what's translated and measured here. And again, it becomes smoother than momentum. It becomes really fast at giving us an idea of where trends are going. And so the crossing over of this line from the zero is what we're looking for. So you take this period where we've come down and crossed below, well, again, you can see that we're right near the top of this market there. Similarly, when we went from negative through to positive, crossing the zero there, well, you can see we're pretty early on in that rise up. So a nice trade there just by staying long when we're above zero on the MACD. So very simple signal there. But it's built from that signal line above. All right, so again, here are the different lines. So you can see here the typical MACD display. We have our oscillator, which was the shaded area before, but we took that shading off. And then we have our signal line, which is the moving average of the oscillator, and then the difference between is our histogram at the bottom there for the MACD. Again, we can look for divergences, so we see this period here where price was making higher highs, but when we look down here, the indicator was making lower highs. And so that's clearly some bearish divergence going on there. We get our drop, and then we're away again. So these are things that we look for there. Trading on crossovers, it's very simple to say when it's above zero, then the market's in an uptrend. So that's there. Now, rate of change builds on momentum. So instead of just taking the value of the difference, it's now taking the percentage of the difference. Very same calculation. The shapes of the two are virtually exactly the same. As you can see on that plot there, we've got the momentum at the top and then the rate of change at the bottom. Their shapes are the same, but the values are different. So they're both giving you the same sort of information together. RSI, we've talked about this a couple of times already, developed by Wells Wilder. Again, more stable than momentum because it uses all the values rather than just today's value and the value 10 days ago. Well, it will use all the values in the whole look-back period, takes the positive values and the negative values and adds them together and calculates a ratio. So again, it's a little more stable. Stability usually comes at the expense of lag. So you do get a little bit maybe of more slower reaction than otherwise. The most typical indicators, the uses of this. So I'm just reading my notes, making sure I get this right. Measures upwards, downwards movements, compares the magnitudes of the gains to the losses over the look-back period. Yes, I was about to talk about signals, but I remembered it was on this slide. So, when we have a value of 100 on an RSI, that just means that every single day in the look-back period was positive. And we were, everything was going up. 0 would mean that it was all losses. So they're the extremes. Highly unlikely from a probability perspective. It just doesn't happen like that. The real point with a lot of these oscillators is that when there's been too much movement in one direction, we're just expecting some sort of correction in the market. The traditional levels for the RSI is 70 and 30. So above 70 is overbought, below 30 is oversold, and we look for some sort of turns in there. Next one, which is a variant of that, is stochastic. So what stochastic does is it just looks back through the look-back period, takes the highest high, the lowest low, and says, well, where are we today in that range? And so it calculates a ratio of where we are and plots that value. So it's actually quite different. Most of the oscillators we talk about just use the closing price, whereas stochastic uses the high and the low. So it's a little bit different like that. We use this concept of fast stochastic versus slow. So, that calculation of the stochastic value of that ratio, you then put on a 3-period moving average. And that's the signal line. Now, in stochastic speak, George Lane created this idea. He called the ratio line the %K, and then the moving average the %D. And that's the standard stochastic. Now, in Optuma, we call that a fast stochastic because it's very quick and moves up and down fairly quickly. So what was done to try and slow that down was to take the %D and now do another moving average of that, another 3-period moving average. And it just slows everything down and makes it a little easier to use. In Optuma, that's called a slow stochastic. Sometimes, people will talk about that being a 10-3-3 slow stochastic or a 10-3-3 stochastic. If you see 3 numbers in the stochastic, it's a slow calculation. If you were to only see 2, for instance, in this case, 10/3, then it would be a fast stochastic. So just keep that in mind as well. Usually though, we'll only show 2. Even though we have the 3 numbers, we only show the last 2 there. Williams %R is just the opposite. Rather than looking where we are from the close up, he looked from the high down. Other than that, they're exactly the same. So what I've done there is I've put on a stochastic and a Williams percent R. They're both using the same scale, and you can see they're exactly the same shape, just one's above 0 and one's below 0. But that's all that's different there. Commodity channel index, sometimes called cycle channel index. Not very often. Its more common name is the commodity channel index. Again, you know, what we're looking at here is the prices. This is often used in cycles tools as well, as a way of trying to find cycle patterns and things as well. It's not bounded. It can go really high values in the calculation there. But what they did find was that 70 to 80% of the values fall in that range from minus 100 to 100. And so it's the excursions outside of that 100 range that we're most interested in. Overbought, oversold type indicator as well. The extremes are actually, you know, said it was used as cycles. Look, for CMT1, you don't need to know this, but values over 100 were highly probable of having cycles that are turning. But yeah, that's for when you get to CMT2. ADX is another fantastic, you know, basically we use this in the moving average lessons as well, but again, it's a common oscillator that we use. And just touching on that, when the green line is rising, this one's a little bit different. You know, most of these oscillators, if they're rising, price is rising, oscillators rising. ADX, the green line in the ADX just tells us the strength of the trend, whether that trend is up or whether that trend is down. So it's not giving the same sort of information there. But it's very responsive to changes in trend. And remember, our primary goal as technical analysts is to identify changes of trend and then be able to trade with them. And that is it for basic oscillators. So your requirements for this section is basically to identify the characteristics of all of those other indicators and make sure that you understand them and you understand what they're trying to measure, you know, how they work. And then if you have that knowledge, you'll be able to answer all of these questions in the exam as well. Thanks for watching, and we'll continue on the next session.